broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi. Good morning. No US session to kick off. At least, give us a bit of a fillip. So we pick up from where we left off yesterday, which is not exactly a great place.
It is not. And we actually retraced almost 1% from the day's highs yesterday. Yeah. There's no good news which is cheering the markets yet. So I guess, that just goes to show that perhaps the texture of this market has weakened a bit.
Looks like it, Sonia. The point is that we are stuck in a range, right? For the last so many sessions now, actually most of 2023, and this is the third week running, we are in a bit of a range. What is that range? The range is between 17,780 to 18,260. And the market is also quietening down a little bit, right? Last week was very volatile, very large ranges. It's just one day of the new week, but just seem like that things are quietening down. Is this the lull before the storm, or is this generally, ebbing out of the volatility all the way into the budget, and then we see the move? We'll find out. In any case, the supports are, nothing has changed. The supports are 17,774, which was the December swing low. Then we made a newer low, which was 17,761. So that broadly becomes the support. If you want to go with one number, it's about 17,780. That's the sort of line in the sand. At the day's low yesterday, that number was, that support was about 100 points away. So let's see what happens. But that's the support which has been in place for some time. Yesterday, by the way, the Nifty turned down exactly from the 20-day moving average. I only noticed this morning. 18,051 is the 20-day moving average. Yesterday's high was 1849 and point something. So we almost got to that 20-day, and then there was a sharp reversal which took place. And the 20-day at 1851 becomes, we've been highlighting that for a while now. Once we take that out, we can talk about levels of the 40 exponential day moving average, which is slightly higher, and then maybe bigger retracements, etc. But first, you need a solid close above this 20-day moving average. Yesterday, we got to it intraday, and then there was a sell-off. So as we've been saying, either a break above the 20-day or a break lower below the lower range of 17,780. I think that is what will give a clear directional indication of what the market wants to do from here. Maybe we perhaps stay in this range, and then finally we get a kind of some kind of a trigger, and then one of these levels, either higher or lower, is taken out. Bank Nifty also sold off yesterday. That index ended about 0.5% lower, and this is despite PSU Bank Index being up 1.5%. So banks are also another kind of problem point, at least on the private side. On the way down for the Bank Nifty, 41,729 and 41,569 are important support levels. These are basically lows over the last 10 days or so. And on the way up, again, we go back to the 20-day as the reference point, which for the Bank Nifty comes in at 42,622. So here also, we are in a bit of a range. Within sectors, the two areas which stood out was the PSU Bank Index and the IT Index. We don't have cues from NASDAQ indicating whether, what the US may look like. PSU banks is an interesting area. It's come back after a very steep 13-14% sell-off from the earlier high. And it's almost back there. Another couple of percentage points, we're going to be back at the highs for the PSU Bank Index. So is this the space to focus on? We'll find out. But momentum seems to be back in a range of these public sector bank names. Guys, hi, morning.
Absolutely. Morning, Prashant. Morning, Nigel. And there's some very interesting observations, right? For starters, the Nifty failed to hold on to its gains yesterday. It's failing to hold on to highs. So in that context, we are now at the lower end of the trading range. And this morning, the SGX Nifty is also indicating that the start will be very, very quiet. The flows have also thinned out in that sense. So perhaps in the run-up to the budget, there are a lot of expectations this time around as well. There's a lot of macro data coming out. So maybe it's just wait and watch mode. FI sold about 750 crores. DIs bought 685 crores. No trading from the US markets. Now, commodities continue to inch up higher. So whether it's Brent, whether it's gold, whether it's crypto, all are doing well. Crude is back at $84 a barrel. Gold is at a 9-month peak. Cryptos have been moving up as well. So equities as an asset class has moved to the back burner. But one very interesting trend that I spotted in the last couple of days is that this month, the IT index is up while the bank index is down. So the Nifty IT index is up about 2.5%, while the Nifty bank is down. So is that, that shift happening? That's something very interesting. And IT, after a steep fall, is seeing a bit of a revival in the month of January. Lot of big earnings talking about banks. You have Bank of India today, there's IndusInd Bank tomorrow, there's ICICI Bank on Saturday, and then of course you have Reliance on Friday as well. So some interesting trends is what you're seeing, but by and large, the Nifty has moved to the lower end of the range, and it's refusing to sort of react positively to good news. So let's see if there's any trigger that can take it higher.
Well, that's right. So yesterday, both the Nifty and the Nifty Bank, both of them went to the 20 DMA. The problem was we couldn't hold on to those levels, and from there we did see correction from the highs of the day. For me, the positive though yesterday was that the broader markets, that's the mid cap and the small cap indices, well, they were relative outperformers in yesterday's trading session, and select stocks, they did well, though the headline index was under some pressure. The cues coming from the FI as well, they are bearish. They added shorts, they bought puts, and they wrote calls. Now, those are bearish cues that are coming in there, and the short positioning now is at around 60% odd. The hope is, since we are moving closer to around the lower end of that band, they get trapped on the short side, and in fact, then we see a bit of a relief rally from around that 17,750 to around 17,800 odd. The call writing, that's a little bit worrying though, because they wrote close to around 1.5 lakh calls yesterday, and that was in a ratio of close to around 15:1. So that's aggressive call writing. At higher levels, you're expecting supply to come in there. So, even if you're working with a relief rally, it'll be a relief rally at best, 150, 200 points odd. Just take a look at that, 18,100, 18,000 call. Between them, close to 90 lakh shares getting added out there. And there were aggressive writing that was seen out there. On the downside, the 17,900 put, it has the highest open interest. So still, the hope is that that 17,800 level holds out. Yesterday, though, in the final hour of trade, there was shedding that was seen because still around 230 odd, there was addition out there. Now, the PCR moves to around 1 plus, then risk reward doesn't favor the bulls. But when it moves gradually to around 0.7 odd, that's when risk reward favors the bulls. So short point is, watch for the PCR to cool off a little bit and, try to get it more closer to around the 17,800 odd mark. The 20 DMA, that's the near term resistance zone. While in the last couple of weeks or last month or so, we have seen that you get in at around 17,750, you get in at around 41,750 on the Nifty Bank, and risk reward favors you. SGX Nifty suggesting a flattish start. Let's see, we'll get an intraday dip at some point of time. That'll be a good entry opportunity closer to around the 17,800 odd mark.
Okay, just wanted a follow up on the IT point that we were making. The IT index I just checked is up almost 2.2% this month. And if you look at individual stocks, it's not a big move or anything, but there's still about a 2 to 5% rally you've seen across stocks. HCL Tech is up 5.5% this month. TCS is up 2.3%, TechM is up 1.7%. So question we're asking is, is the worst of the IT fall now behind us? In fact, we have a comment and equity call coming in from Gautam Dugar in just a while, and he makes that point about how perhaps it's good to nibble into the tech stocks now.
Not IT services, but IT per se in NASDAQ, etc. These are what you describe as long duration stocks, right? I mean, companies which will earn money sometime down in the future. Not Indian IT. Indian IT is extremely positive. But if there is any correlation between Indian IT services and IT product companies in the US, I mean, the big cue for them, at least, is fall in interest rates, right? Rates going up has been the big problem. And I think one thing we can say with some amount of, not complete certainty, that inflation is a big problem, is a 2022 problem. It's not a 2023 problem. And if that is the case, then, it gives a lease of life to US tech, which is in many ways very different from Indian tech. But it at least gives some amount of fillip, all right? For Indian IT, what matters is the second derivative problem of slowing inflation, which is the cooling off of the US economy. How sharp, how severe is that going to be? I think that is the imponderable. So, I mean, it's the point is, and I think what makes sense is, as many have pointed out in the programs here over the last couple of months, maybe Indian IT services buy into weakness. This is a very profitable, perhaps one of the most profitable parts of the market. And I think, shouldn't stay too far away, at least have some exposure at times like this. Well, before we start, let me quickly tell you what's lined up here in the first half hour of the show. We will get you updates from markets across the globe, and Ed Yardini of Yardini Research will join us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day, and around 8:30 a.m. this morning, we'll do a fundamental market analysis with Deepan Mehta of Elixir Equities.
All right, on the equities, now we have an opinion coming through first up from Gautam Duggad of Motilal Oswal Financial Services. He expects the market to remain range-bound and take cues from corporate earnings. He says they prefer sectors like BFSI, which will remain in focus due to heavy results calendar. He says technology earnings are better than expected and HDFC Bank delivered an in-line set of numbers. He adds they will now nibble into technology names like Infosys, TCS and HCL Tech and will also buy financials like Axis Bank, HDFC Bank and SBI.
Well, let's get you some money market views as well. This is Bhaskar Panda of HDFC Bank who says dollar index seems to be finding its feet around current levels as market participants await US Fed action. He says optimism in Asia is high as China reopens, but the flip side is that oil is rallied and Brent is trading around $84 a barrel. Pivot today. Indian markets, he adds, the recent trend of rupee appreciation stalled yesterday. The dollar INR pair turned around on bids from importers and others on a US holiday. This is, of course, yesterday's price action. He goes on to add support remains around 81.5 to a dollar levels. He expects the dollar INR pair to trade in the range of between 81.5 to 81.75 for the day.
Okay, and on the bonds, Bhaskar Panda says in the Indian bond markets, yields have firmed up a bit on expectations of higher borrowings and higher oil prices. He expects some consolidation around current levels in benchmark yields and sees the 10-year benchmark bond yield trading in a range of 7.3 to 7.35%.
Well, we've got plenty of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at ONGC, Reliance Industries, Angel One, Kesuram, Tinplate, JSW Ispat Special Products, Phoenix Mills, India Pesticides, as well as Ashok Bilkar. They are stocks that are likely to react to positive news flow. But on the flip side, you have Sambandhan Motherson. That's the only stock that could open up in the red.
Okay, all right. So that's basically stuff we will get to in just a bit from now. But let's get you a global perspective. Ed Yardeni, president at Yardeni Research, is now joining us. Ed, good to have you with us here. Thank you very much. I was talking to someone here in India who's in the global KPO side, I mean, sort of knowledge providers to large US firms. And the feedback is that firms are in the US, large firms are tightening their belt quite aggressively, preparing for perhaps what is a very well advertised recession. It's coming. It's around the corner. Everyone is ready for it. How bad is it going to be, I think, is the only question which remains.
Right.
Your thoughts, Ed? I mean, because this has got implications for markets, earnings, etc.
Well, I seem to be in a minority of economists and strategists who don't think we're going to have a recession this year after all. If we do have a recession, it'll be the most widely anticipated recession of all times. And I think we've already seen a lot of people and companies make adjustments so that they're just not vulnerable to having to scramble to suddenly move into recession mode. And meanwhile, the latest data continues to show that for all the talk of a recession back in 2022, the economy did quite well. Instead of a soft or a hard landing last year, there was no landing. Economic growth actually picked up in the second half of last year. I think that the economy is going to do quite well. I think it's very resilient. And I think we are going from the new normal of unconventionally easy monetary policies, which we had from 2009 to 2021, back to the old normal, where the economy can grow, inflation is somewhat higher than in the past, and interest rates are maybe between 3% and 4%. And I think that would be a good thing.
That's great. So after all that nervousness, excitement,
yes,
finally the expectation is that there won't be any recession after all. Well, how do you see markets react? Because, I mean, it has been a very tumultuous time for global markets. Now, even back home in India, the market is sort of refusing to even react to good news. Do you think, if you believe that there's no recession coming, is this the time to go all in into markets like India?
Yeah, look, the problem with the idea of all in, it's not as though this market is going to go straight up. I think we did make a low in the bear market on October 12th of last year. I actually thought it was back in June that we made a low when we got to 3,666 on the S&P 500. But I was wrong, and it turned out that we went lower on October 12th, but it wasn't much lower. I think it was a retest, and ever since then, the market's been going up again. Now, in the previous rallies we've had in the bear market, the Fed came and slapped it all down. But this time around, I don't think the Fed's going to do much more than 75 basis points over the next few meetings at 25 basis point a shot. I think they're already where they want to be, and I think the economy can handle it. I'm very impressed with the behavior of the market when I look at the S&P 500 equal weighted as opposed to market cap weighted. On an equal weighted basis, since the bear market started or the bull market ended on January 3rd of last year, let me look at my numbers here. The S&P 500 is down 16.6% since the January 3rd, 2022 peak, but the equal weighted is down 8.4%. So we're really seeing a broadening of the bull market. But again, it's not as though stocks have gotten that's ridiculously cheap as they typically get in bear markets. They're kind of fairly valued. So I think we're in a stock picking market. Stock pickers, I think, are going to do better than momentum players.
All right. Morning, Ms. Yardney. What about China? We just got some data around half hour or so ago. The retail sales contraction is not as much as expected. The Q4 GDP is better than expected. And the other data points as well that are coming in from there are fairly good. Yeah. What's your sense in China? This reopen is really playing out. Go ahead, sir.
Yeah. I think the reopening is probably working. It's sort of a tug of war between the virus and people just sick of being locked up and wanting to go to work, wanting to go out and spend money. And there's a tremendous amount of pent-up demand because of the lockdown, certainly of the past few months, if not the past 3 years. So I think China is going to recover. I don't think they're going into a recession. By the way, I don't think Europe's going to go into recession because the market forces work. The price of natural gas soared, and as a result, there was a tremendous amount of increase in production of gas that went to Europe. So Europe looks okay. China looks okay. India certainly looks fine. And the U.S. is doing, I think, will do relatively well. So contrary to what the World Bank is alarmed about, I don't think we're going to get a global recession. And I think a diversified global portfolio makes sense here.
No global recession, but global disinflation is here to stay. Ed, because that is required for markets, for stock markets
absolutely.
to do well.
That's absolutely required. I think we are seeing that, well, at least in the United States, we've seen that consumer goods price inflation has come down dramatically. Durable goods inflation is slightly negative on a year-over-year basis after being up something like 18% on a peak basis last year. So we are seeing consumer durables goods coming down. I think food and energy prices stay high, but I don't think they go up. I don't think they go down. So when you take the year over year, that's kind of no contribution to inflation. The issue is services, and everybody knows that in the United States we have a problem with rent inflation, and we know that current leases, new leases, are that inflation rate's coming down quite sharply. So the pandemic created all kinds of messy situations around the world. And I think we're still sorting out the impact of the pandemic. And as it sort of dissipates, I think we're getting back to normal.
Okay, well, I wonder what normal is, right? The meaning of the word normal has perhaps changed post-COVID. But you ended the last, statement by saying that a diversified portfolio, global portfolio, is the need of the hour. What do you mean by that? Do you raise your allocations to gold, to commodities? There are alternate asset classes which are back in action. What's the asset allocation strategy for the year?
Well, I tend to focus on stocks and bonds. Commodities are extremely volatile. They're hard to invest in other than through the stock market. Otherwise, you're in the futures markets or taking delivery of the product, which makes no sense for investors. I'm looking for the global economy to do better than is widely anticipated. Commodity prices are already indicating that. We've seen that in copper. We've seen that in oil. We're seeing that in gold. And so stocks related to commodities of companies that produce commodities do make sense here. But so do industrial companies. So do cheap technology companies that have gotten beat up here quite hard, and financials look quite good. I understand that your banks are in better shape. Well, in the U.S., the U.S. banking system is in very good shape. So I think all in all, view the 2023 as a recovery year and invest along those lines.
All right, Ed, good to speak with you. Thank you very much for your time, and it's always a pleasure having you with us here.
My pleasure indeed. Thank you.
Well, time for a quick commercial break here, but as when we come back, what we'll do is we'll sort of turn our attention towards stocks, where there is news flow, both positive and negative. Our research team will be with us. Stay tuned for that.
Welcome back to Bazaar Morning Call. This morning, the SGX Nifty is very quiet, but our own markets have moved to the lower end of the trading range. The interesting bit is that IT stocks have come back. There's some buying there. So we'll talk about all that and more. First up, our research team is here to give you the list of top 10 stocks. Samvardhan Motherson is on our radar this morning. Vivek is here to tell us why. Vivek, good morning.
Well, good morning. Samvardhana Motherson is on the radar. You know, what we understand from our sources is that there is expected to be quite a large block deal in this particular name today. So Sojitz Corporation, that at the end of September quarter held almost 3.46% stake in the company, is looking to further pair stake. We understand from our sources that a 1.6% stake in the company is what they are looking to sell via block deal in today's trading session. We understand that the deal is likely to be at a discount of close to 6% to yesterday's closing price. So the floor price works out to around 71 rupees per share. The deal size is close to $92 million. Remember, on October 18, 2022, at 64 rupees a share, you know, Sojitz had already sold around 12.8 crore shares. So now they'll be with a very minimal stake after this particular block deal, going with the red on this particular name on the back of the potential supply, as well as a significant discount to the current market price.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Sonal. She'll tell us about the windfall tax cuts. Sonal?
Good morning, Nigel. Well, yes, after 15 days, it has come through yet again. And this time around, it's a positive for oil producers and Reliance Industries as well, because the windfall tax on petroleum crude has been cut to 1,900 rupees per ton from 2,100 rupees per ton. Export duty on diesel has also been cut to 5 rupees versus 6.5 rupees per litre. And on ATF, it has been cut to 3.5 rupees per litre from 4.5 rupees per litre. On petrol, it continues to remain nil. So it's positive for the likes of Reliance Industries and oil producers like ONGC and Oil India.
Okay, thanks a lot for that. Let's go across to Surbhi now. She's tracking Angel One this morning. Surbhi, over to you.
Hi, thanks for that. So decent numbers by Angel One. The revenue growth was kind of flattish at 719 crores. Their EBITDA is up 2.4% at 294 crores and margins have come in at 41%. The beat is on the profitability front, where the PAT is up close to 7% at 228 crores. Now, when you look at the internals, a lot of these internals were known as they gave their monthly business update earlier this month, and it is factored in the price. The number of orders were down 2% at close to 23 crores. Their average revenue per client was also down 7% at 398 rupees. Their gross client additions, that was down 16% at 9.88 lakhs. And their active client ratio is at 34% versus industry client activation ratio, that is at 33%. Over and above that, the board has also declared an interim dividend of 9.60 rupees per share.
Okay, thanks a lot, Surbhi, for that. But Nigel is also tracking some other earnings. Nigel, what are you looking at?
Well, I'm looking at 3 stocks, Sonia, and the results for all 3 on a year-on-year basis are weak. But the positive is that on a sequential basis, there is some margin improvement, and the hope is that in quarter 4, it's even better. Kesoram Industries. The revenue, well, there was a growth of close to around 13% odd. The EBITDA number, though, came in lower, and the finance cost has come in lower. Remember, for Kesoram Industries, the big question is, can they get out of this debt trap? We'll have the management later on today, so we'll get a sense on that front. But margins have improved sequentially, so we're going with green on that one. Next up, Tinplate. On a year-on-year basis, well, the revenues were down. The operating profit was sharply lower, but the profit number as well did take a hit. However, they're a debt-free company and they have cash in their books, so that's why the other income was higher as well. On this one as well, from a loss that we saw in the previous quarter, they have moved into profitability yet again. Remember, there's a pending merger with Tata Steel. So not probably the next few months, we won't be tracking tinplate, we'll be tracking just Tata Steel. And finally, JSW Ispat Special Products. This one as well, you have a pending merger with JSW Steel. Out there as well on a year-on-year basis, numbers looked weak. However, on a sequential basis, they move back into profitability. So maybe, in fact, things could improve from here on as well, going with green on all these three.
All right, Nigel, thanks very much for that. Those are a bunch of stocks to watch out for from the commodities, the metals space. But Sonal is here with more stocks with news flow. Sonal, hi, good morning.
Good morning, Prashant. 3 stocks on my radar. Phoenix Mills, where the company has completed an acquisition of Janus Logistics for 26 crore rupees. It is done via a wholly owned subsidiary. And the company that they have acquired has a land parcel measuring 33 acres in Haryana. So this is with regards to the mall expansion plans that the company has in place. So one more approval is what they have received here. India Pesticides will be in focus because they've announced the launch of a herbicide technical product, and it will be manufactured at their Sandila plant, and it is only for export markets, exclusively for that, where the company says that the demand for this product is very strong in the international markets, and that is something that they can build on in terms of revenues as well. Ashoka Buildcon, for one of their HAM projects, they have announced 19 November as the commercial operation date. This particular project is executed by an SPV, which is also a wholly owned subsidiary of the company. And this SPV, according to the company, is eligible for receipt of annuity payments from the NHI. This is for a period of 15 years. It will start from the complete commercial operation date, that is 19 November, and it will be paid at an interval of every 6 months.
Okay, thanks a lot for that. Well, let's do one thing. Let's do a quick recap of our top stocks with positive news flow. There's ONGC, Reliance, Angel One, Kesoram Industries, Tinplate, JSW Ispat, Special Products, Phoenix Mills, India Pesticides, and Ashoka Buildcon, while the only stock with negative news flow on our radar is Samvardhan Motherson. So do keep an eye out on that stock. But a lot of commodities continue to inch higher, whether it's gold, even crude, and even cryptos, by the way, are inching up higher. Manisha is joining in to give us a quick roundup of all the action overnight. Manisha, good morning.
Morning, Sonia. Well, absolutely. The dollar decline and the fact that 25 basis points of a rate hike is what the markets are factoring in clearly seems to be supporting across asset classes. So when you talk about the crude oil prices, we are holding steady at $85 a barrel. The markets are watching out now for the OPEC and the IEA market outlook that gets released today and tomorrow. The crude prices did gain 8% in the previous week, and we are holding on a firmer note right now. After 2 days of all-time highs in gold, today looks like a day of consolidation because the international gold prices have come off its highs. So after hitting a 1930 of a high, we are trading at around 1910 right now. So $20 off its highs, and that will reflect in the Indian markets today. But one sector that continues to surge is the metal prices. 8 to 10% of gains in 2023 till now is what copper, aluminum and zinc have posted. And today as well, after the Chinese retail sales, industrial output data, all of that is out, while it is still on the weaker side, but better than the street expectation, and that in turn has been supportive.
All right, Manisha, thanks very much for that. Now, the RBI has issued a discussion paper that seeks to move banks towards an expected loss approach with respect to bad loans. Now, what does this mean for listed banks? Lata is here to explain. Lata, hi, morning.
Good morning. At the moment, banks provide loss after they incur the loss. They make the provision. That is, after loans don't come back for 90 days. Now you have to make provisions when you expect a loss. And incidentally, your US and Europe are already in that regime, and so are Indian NBFCs. Now, what does the discussion paper say? It asks banks to classify all loans as stage 1, stage 2 and stage 3. Stage 1 are all standard. Stage 2 and stage 3 are where you are expecting a loss. Now, at the moment, there is already something called SMA-1, SMA-2. SMA-1 are loans which people have not paid interest for over 30 days. That is 30 to 60. From 60 to 90 days, if it is past due, then it is SMA-2. Those you may have to provide. Actually, what RBI says is banks have to make their own rules on where they expect loss. For instance, if a company's debenture, which is floating in the market, has been marked down from, say, AA to A, that is a company-specific expected credit loss. Or it could be commodity prices have crashed, and therefore some commodity companies could see loss in future years. Or it could be some macro things, like COVID. But the point is, the rules are made by banks, but they have to be validated by a third party. And Reserve Bank will also provide some minimum provisioning that will have to be made so that everyone is on the same page. Now, what is the impact? I have to emphasize that there is no immediate impact. This is the discussion paper. In the next stage, there will be draft guidelines and then only final guidelines. Then they get 1 year to prepare for it. And, one expects there is going to be higher provisioning because Reserve Bank itself talks about, capital shock. If you are not able to carry your profit into capital, then your capital doesn't grow. So that capital shock, you will get 5 years to grow your capital. The way the discussion paper is worded, it does look like there could be higher provisioning. What do the experts tell us? Well, I've got 2 or 3 brokerages. CLSA says that the migration to expected loss will lead to a rise in provisioning. But since private banks already have higher provisions, and even the large public sector bank, probably it is the other public sector banks which could be, in a process of having to increase provisions in the days to come. Macquarie points out that the expected credit loss will have to be calculated on the basis of probability of default. Now, how do you judge probability? You look at the last 10-year record, or for last 5 to 10-year record. That record has been high NPAs for banks, and therefore there could be higher provisioning. He also expects that, public sector banks will have to start adding provisions, which means their profits and ROA could start falling. And likewise, Morgan Stanley also says that the potential impact won't be much because banks are in ship shape now. They will have enough time to gather the provisions. The long and the short of it is no immediate impact. And when the impact hits, private sector banks are better off than public sector banks.
Okay, thanks a lot, Lata, for that. Let's take a quick break. On the other side of the break, we'll pose all of these questions to Dipan Mehta of Elixir Equities, who will join in for some fundamental analysis. We'll also have Vinny Mehta of the ACMA to discuss the demand outlook for the auto component manufacturers in 2023. Stay tuned.
Welcome back. Hope you're having a good morning. Well, for starters, the SGX Nifty has been moving around. The last I checked, it was more or less flattish, and that's what it's holding at. But let's discuss a few stocks. Dipan Mehta, Director at Elixir Equities, joins us on the show. Hi, Dipan. Thanks so much for joining in. Well, Dipan, Sambandha Motherson, there's going to be a large deal that's going to be taking place. And there's some pending shares that will be sold. What's your take on this company? A few days ago, we had news coming in from Volkswagen that maybe business is not that good, and the stock reacted to that set of news. Your sense on the stock?
Yeah, Nigel, good morning, and thank you for having me on your show. I'd like to be a little bit underweight as far as Sambandha Motherson is concerned because of its exposure to the global auto industry. And while we are seeing very positive trends from the auto OEMs in India, and therefore very positive on the Indian auto ancillary sector, which are focused on the Indian companies. In the case of Motherson, I think it's impacted not only in Europe, but US as well. And considering the global kind of headwinds which are there and the talk of recession and lower consumer spending, auto industry sales globally are going to be impacted, and that certainly will affect Sambandha Motherson. So I like to be a bit underweight. Valuations are fair. And there are many other good choices on the other Indian auto ancillary companies like, say, Minda Corp or Minda Industries. I think they're all doing exceedingly well. So our focus has to be over there.
Okay, well, since we're talking about companies that are doing exceedingly well, I wanted your thoughts on Federal Bank. The numbers were, banging this time around. I mean, you had and a lot of brokerages have actually gone ahead and raised their target price. I think Citi has raised their target price to 165. Morgan Stanley has raised it to 175. Motilal has 170. So clearly the street likes the numbers. You think it's too late to get into Federal Bank, or is there still more upsides here?
Good morning, Sonia. No, I don't think it's too late because Federal Bank is still available at attractive valuations. It is a discount to some of the larger banks like the top 2, 3, 4 private sector banks like HDFC, ICICI, Axis Bank. So you can always expect a re-rating of the price to earnings, price to book ratio as well. And being a small bank, it's been a well-managed bank. You can expect the smaller base effect to benefit the company going ahead. And next few quarters also will look as impressive as this. These are great times for banks with a high degree of demand for credit. which brings in higher credit and higher net interest income, higher fee-based income, and the costs have not yet gone up because NPAs are well under control. The only costs which are going up are those for technology and for manpower, but that's easily containable and manageable given the way the business and the book size is growing. So yes, very positive on Federal Bank. And I think it could be one of the good mid-cap outperforming banks in 2023.
Dipan, hi, good morning. Prashant here. DMart sold off yesterday. I don't know if you have any thoughts here. PVR was down some 4-5%. There was a Kotak downgrade, which we alluded to all day. And actually lots of liquid large names, right? Astral, Devyani, the Nykaa, PB Fintech, a fair bit of selling in some of these names. Go on.
Prashant, good morning. You know what the common thread across all these companies is that they are quoted at very high valuations and they have disappointed as far as the numbers are concerned. Whether you take a PVR because of the way the footfalls are taking place, Astral also you see last Q3 numbers, what has come through. And in the case of Avenue Supermarket also, the kind of disappointing numbers which have come through. So I think investors, especially loyal investors who have been invested in these companies for years on end, because most of them have been multi-baggers with the exception of perhaps Nykaa, they are now, I think, slightly lightening up their position, throwing in the towel. They're taking a review of their portfolio that, look, these are companies, they're expensive, they've created a lot of value, but now it's time to perhaps book a little profit over there and go for companies where there is growth as well as reasonable valuation. And I think that's what's playing out across the board in a lot of companies which we have classified as growth, which have great managements, have built a lot of wealth. But then I think because of base effect or some other macro factor, the earnings will not be as strong as it was, say, in the last 3, 4, 5 years or so. So I think that's what's playing out over here. And more companies perhaps may join this list as well going ahead.
Okay. I do want your thoughts on the technology names as well, Dipan, because, now in the month of January, we've seen a bit of a pullback there. The Nifty IT index itself is up almost 2.5%. CP Gurnani, the current managing director and CEO at Tech Mahindra, spoke at Davos, and he said he will continue to be at the helm of the company till the end of the year. So he did give more clarity on the succession plan. Let's listen in to what he had to say when asked about the next CEO, and then we'll come back.
The communication to the stock exchange has been very clear that I am on the saddle till December 23, and the successor would be a CEO designate. There is no immediate announcement, so we will have to wait for a little while.
Okay, no immediate announcement of a successor, but in any case, he's staying put for a while. Dipan, for the sector as a whole, we were just discussing a while back as to how most of these stocks have gained about 5 to 7% this month. You think the worst of the fall is now behind us, and is it time to start nibbling into large cap IT names?
Yeah, I think so, Sonia. The reason is that I think street expectations were very low for these companies, and that always benefits, the stock prices post declaration of numbers. And by and large, I was pretty impressed with all the financial reports which came from all these companies. Growth seems to be intact. IT spending is far more resilient than we thought maybe 2-3 months ago or so. Sure, there are going to be challenges. There are macroeconomic headwinds, and Europe is not looking as great. But on the whole, I think Indian IT companies have navigated this uncertainty very well. And I'm really looking forward to what the mid-cap IT companies have to say, because they are in a slightly different kind of a zone as compared to the large-cap IT ones. But my sense is that things are not as bad as it has made out to be. And hopefully, I think if all the recessionary fears and cuts in spending, if once we are through with those, perhaps end of 2023 or so, you may again see a decent rebound in tech spending, which will benefit Indian IT companies. I think with every recession, Indian IT companies have gone from strength to strength, and this is playing out over here as well. So very positive on these companies. I know valuations on the higher side, but these are great businesses with good secular long-term growth rates.
Okay. All right. Dipan, just stay on for a bit. We have a quick discussion on the auto sector as well lined up. The domestic demand environment for the auto sector in this quarter is expected to be stable post the festive season. Also, there are a slew of new vehicle safety and emission norms that are expected to be kicking in the coming months. To discuss how the demand environment for auto component manufacturers is shaping up, Vinny Mehta, Director General at ACMA, joins us now. Of course, Dipan is also sitting by. So, Dipan, I'll be tossing some questions to you as well on the sector. But, Vinny, I want to start off with you. you. You know, the pent-up demand was there, but it's now normalizing a bit in the passenger vehicle space. And now you also have higher regulatory costs that come in from April of 2023. Do you see demand cool off a little bit for the sector? I'm quoting from a Nomura report that expects the passenger vehicle industry to slow down to just 6% in FY24 from 23% in FY23. Do you think it could get as bad as that?
Sonia, very good morning to you from a very crispy, cold Delhi. I'm not too sure about it. We'll see how it happens because, you know, the Indian market can always surprise us. As of now, some of the companies are looking at a very good 23 and also 24. So we will see how it shapes up. But I don't think so there are, as of now, signs of slowing down domestically. But yes, you know, for exports, there could be a little bit of a challenge with Europe and US getting into some recessionary trends. So at this juncture, honestly, it's like a wait and watch. It's too early to say, you know, how things would be for the whole of the year next year. Yeah.
Okay, so it's too early to call the year. Since you, you know, you are at the helm of ACMA and you, of course, speak to a lot of these component manufacturers, I wanted to understand a little bit about the potential in the electric vehicle space, because a lot of companies, right, whether it's Sona Comstar, Uno Minda, are putting in capacities to cater big time to the electric vehicle sort of universe. Can you tell us a little bit about which are the companies that are making big headway there, and what do you see as the potential?
Yeah. So I think what's very, very interesting is that electric mobility has caught on to the imagination of the government and the people more so, if I may say so. And of course, there's a huge traction when it comes to the two-wheeler industry and the three-wheeler industry, to be very, very specific. So we're typically seeing consumption or demand from the two-wheeler, something like 75,000 units a month. And a lot of the OEMs are now getting into, are already, including the conventional ones, are focusing on electric mobility. So we did a study sometime in September last year, and what comes out is that by 2030, you would have 70 to 80% of the two-wheeler industry being electric. You would have something like almost 100% of the three-wheeler industry. And of course, a lot of this is driven by the FAME2 scheme of the government, and hopefully the PLI scheme will also aid to it. But on the passenger vehicle side, the movement is somewhat slow. You know, not too many players as aggressively into the space, and the subsidy isn't also as attractive enough as of now. So we see something like 15% of the car industry converting to electric by 2030, and the commercial vehicle space would be much slower because, you know, we really need an economically viable solution what doesn't exist globally. Although on the buses front, there's a huge traction with the government driving a lot of consumption on the buses front. And when it comes to the component industry, I would say that, look, you know, we all know it's written on the wall that sooner or later things would convert. So a lot of the people into the two-wheeler supply chain are, and also otherwise, I would say very generically speaking, tier ones are all probably ready to be part of the electric mobility value chain, if I may say so. Yeah.
Sure. So we have our guest Dipan Mehta of Elixir Equities who's sitting by, and I think he has a question for you, Vinny. Dipan, over to you.
Yeah, Vinny, good morning. I just want to ask you this question that, you know, I've been a car enthusiast, and I look at the kind of new models which have come through from the three large companies, Maruti, M&M, as well as Tata Motors. Do you think that these new models, which are all very exciting and which have got very high aspirational value, are they not the key driver for growth for the passenger vehicle industry? I think I've never seen so many new models coming through from a single company, and they're all lovely models, premium models with so many, you know, bells and whistles in them. So what do you think the impact of new models is there as far as OEM sales are concerned?
So I would say, you know, Deepan, this is the coming of age of the Indian or the Indian auto manufacturers. And it's so exhilarating to see all these people come up with such a, you know, such a huge number of models and at such a rapid pace. And yes, this is going to be driving our industry. And globally, you see what builds the entire ecosystem is the domestic companies. See what drives Germany is Volkswagen. What drives US are the Fords of the world and the GMs of the world. So we need these magnets who will, you know, drive the Indian ecosystem, and you feel so proud about it. Yeah, I mean, it's really nice. It's happening now.
Okay, well, the waiting periods are way too long, right? That seems to be the only problem, the only cog in the wheel.
वो as they say in
so to
Hindi,
speak.
सबर का फल मीठा होता है.
Well, how long? There are people who've been waiting for over a year. But in any case, I mean, that's a production issue.
So
You
some
can't
of
really...
those issues are beyond us,
Yes.
because the semiconductor problem is not yet over. It still continues. Well, continue to 23. Supply chain issues still continues. There are strong headwinds. I'm not denying that. And yet we continue to do very, very well. So I'm extremely proud of our industry.
All right, Vinny, it was a pleasure having you on the show. Thanks a lot for joining in and all the best for 2023. Dipan, request you to stay on for a tad bit. We'll do one thing. We'll take a quick break. Before we do that, let's tell you what's lined up in the next half hour of the show. We'll have Anuj come in for a quick trade setup in just a bit. Post that, we will have the top stock picks from our technical and F&O experts. At 9:10, Nimesh will be there with the standout brokerage report of the day. And before the market opens in CNBC-TV18 Stocks Board, we will highlight the top stocks in the news to focus on for the day. Stay tuned.
Okay, welcome back. Let's just take a quick look at what the SGX is doing. 9 minutes to go for the pre-open session. For the pre-open session, SGX is indicating absolutely flat kind of start. Stuck in a range and not really refusing to break out either higher or lower. That's been the story this year so far. But I have to say, given all of the selling we've seen, and it's now $1.5 billion plus from foreigners, like 22, the damage, at least on the index level, has not been all that great. Stocks, of course, is a different story. But Anuj is here with the trade setup as he sees it. Anuj, hi, morning.
Morning, Prashant. So, we discussed the game of ping pong, and I think it's still continuing. And if you watch two good Chinese players play, it's really, requires a smash of a different level to win that match. And what's happening here is that the market is respecting both sides of the range. It's testing the upper side, is failing there. It goes to the lower side, it fails there. But the decline in Indian market is mostly on its own weight. One thing which has happened, though, is that if you see yesterday's chart as well, the Nifty IT versus Nifty Bank. Nifty IT gained intraday, closed at the highest point. Nifty Bank fell 500 points intraday, closed at the lows of the day. And this month, Nifty IT is up 2.5% and Bank Nifty is down 2%. So there's relative outperformance. And Nifty once again fell from the 20-day exponential moving average. And Bank Nifty, despite the good numbers from HDFC Bank, could not really do well. So the leadership is with IT and metals. Now, if you look at the numbers on the Nifty, the moving averages, they are declining, obviously. So the most important levels that I'll be watching out for are the 10 and 20-day moving averages, which are placed at 17,958 and 18,077. My sense is that the market attempts one more rally here, and especially if 17,800 is protected. The risk reward is in your favor today to attempt a long trade, just as it was in your favor to attempt a short trade yesterday, provided 17,800 holds on closing basis. Bank Nifty, though, is clearly now a sell-on rally. Because the way HDFC Bank behaved and the way ICICI Bank has been weakening and has moved within 40 rupees of 200-day moving average, there's been clearly a subtle change of leadership this month from banks to IT. And my sense is that it could continue for some time.
I have a follow-up there. Because I was just thinking about how ICICI Bank's numbers are on Saturday. So do you think that, generally, for the last few quarters, ICICI Bank has outperformed, delivered stellar numbers. Do you think it could change the fortunes of the bank?
My sense is that even with HDFC Bank, it was not about numbers. HDFC Bank's numbers, you could not complain nothing about the numbers. It's about, the call that you've taken on whether as a sector banks will do well or as a sector IT will do better. And what has happened is backward-looking numbers, whether going forward, especially in case of HDFC Bank, how will the integration play out? And that's why yesterday's price action was purely reflective of that. I think what's happening on ICICI Bank is, and from the evidence or the chatter that we get, is that maybe one or two large FIs have taken a call. ICICI Bank has been a leader for 3 years, and in 3 years, it's massively re-rated. It's just some money being taken off, Sonia. I think one or two large FIs are just taking some money off in ICICI Bank. And I think purely in terms of the Bank Nifty, the leadership is still with ICICI Bank, despite the recent decline.
All right, Anuj, I've hit the nail on the head, I think. So on that one, in the last 45 days or so, ICICI Bank is down 10%. while HDFC Bank is as flat as can be at around that 1600 odd. Maybe some supply over.
One more angle to this, right? We had Kajal Gandhi yesterday, if you guys remember, to discuss the HDFC Bank numbers. And I remember asking her this, my question was, are the numbers really so great? Because, think about it, net interest margins were absolutely flat for HDFC Bank. Credit growth was 20%. PSU banks are now posting credit growth of 23, 24%, right? On a quarter-on-quarter basis, credit growth is 2%. Of course, it's a large base, but the point is that, when I saw people were gushing over the HDFC Bank numbers, it was not HDFC Bank numbers of the past. In a rising interest rate environment,
it's a pedestrian set of numbers.
Absolutely. NIMs being flat. The only reason actually earnings beat expectations was because provisions were sharply lower. So maybe a little bit to be said about the numbers themselves as well.
Just one factor that works for them is one of the few banking names that are trading at a discount in comparison to their averages, right? So that could be one factor. But I'll tell you what, we'll just take a short break. You come back. We'll get our technical experts with us. We'll get you calls on the index as well as stock calls. Stay with us.